For those that are online joining us today, we're just going to give it a few minutes until we start today's presentation. So welcome and just hold on for a few minutes, please. Thank you to all that have come on. We're just giving it one more minute before we start. Okay, we're going to get started. Thank you all. I'd like to open by welcoming everybody to today's presentation. Good morning, good afternoon, good evening, depending on where you're dialing in from today and joining us globally. Today's webinar is titled Unlocking Opportunities, Navigating Group Benefits and Retirement in Canada. Today, our team of experts aim to share insights into the group benefit and retirement markets in Canada and how these can impact your clients with locations in Canada. They're going to share foundational elements that shape the Canadian benefits and retirement landscape. They're going to also share some key regulatory and legal requirements for plans in Canada and how to ensure compliance and build credibility. Their insights today will help you and your multinational clients navigate employer-sponsored benefits and retirement plans in Canada. Just to begin, I'd like to make note of some housekeeping items. If you have any questions throughout today's presentation, we ask that you type them in the Q&A box. We will be monitoring the Q&A and addressing questions at the end of the webinar today. If you require captioning, it is available through the Teams event program. We encourage you to take advantage of that option if required. Today's webinar will be recorded and our slide deck will be sent out after the presentation today. Today's insightful presentation will be hosted by our Cowan benefit experts, AJ and Lindsay Reed. AJ Feltis is a senior consultant in our global benefits team. As a senior consultant, AJ helps national and multinational organizations navigate the Canadian benefits landscape. Partnering with our global brokers, clients, and plan sponsors, AJ has a holistic overview of employee health and wellness from an international perspective, while still taking local norms and Canadian legislation into consideration. With over 5 years of experience in the industry, AJ joined Cowan after working for one of Canada's national insurance carriers before moving into a consulting role. AJ graduated with distinction from Western University with an honors in a Bachelor of Arts Honours in Political Science, and is licensed in Ontario's Life License LLQP program. Nominated for Young Professional of the Year this year by our local chamber, AJ volunteers with Kiwanis and the international organization in his free time. Lindsay Reed is also joining us, Senior Consultant, Pension and Retirement Consulting. With over 11 years of experience in the pension and retirement solutions industry, Lindsay helps organizations navigate the complexities of group retirement programs. In her current role, Lindsay partners with clients, plan sponsors, and human resource departments to design, implement, and manage tailored group retirement solutions that meet unique organizational needs and goals. Lindsay's expertise lies in balancing innovative retirement strategies with regulatory compliance and financial efficiency, ensuring that clients achieve optimal outcomes for their workforce. Known for her strategic thinking and collaborative approach, Lindsay has become a valued partner of organizations seeking expert guidance in the evolving retirement landscape. Lindsay is also the recent award recipient of Cowen's Excellence Awards and was honored with the Cowen Ambassador Award, celebrating Lindsay's innovation, initiative, engagement, and positive representation of Cowen and our clients. Now, without further ado, I'm going to pass it on to the experts and hope you enjoy today's presentation.
Thank you so much for the introduction, Jackie. Looking forward to being here today. Today, we're going to start off our webinar by discussing Canadian benefit plans before diving into Canadian retirement. We're going to set the stage by going over Canada's healthcare system and government-sponsored health insurance, minimum requirements for an employer-sponsored benefits program, as well as some legislative updates. We'll then go over benchmark benefits and what standard coverages look like here in Canada. And lastly, I'll touch on some benefit trends and statistics before Lindsay goes over Canadian Retirement 101, retirement plan design. She'll also speak to trends and considerations for employers to keep top of mind when thinking of their retirement programs. And then lastly, we'll finish off this webinar by talking about Canadian governance of retirement programs. We are going to have time for Q&A towards the end of this presentation. So just as Jackie mentioned, if you have any questions, feel free to send them through the Q&A box, or you can wait until the end and ask live over the webinar. Canada's healthcare system is a group of socialized health insurance plans, and with very few exceptions, almost all Canadian citizens qualify for health coverage regardless of their medical history, personal income, or standard of living. It is a publicly funded program and is administered on a provincial or territorial basis. And although administered on a provincial and territorial basis, all of the provinces and territories here in Canada have to follow specific guidelines that are established by our federal government. Under our healthcare system, Canadians are provided with preventative care in addition to medical treatments from primary care physicians, such as your family doctor, as well as access to hospitals and dental surgery performed within a hospital, but not standard dental services. Also covered by government health insurance are any prescription drugs that are administered within a hospital, and that piece of them being within a hospital is one thing that makes Canadians' healthcare system stand out when compared to other government-funded health insurance programs across the world, is that we don't have a universal prescription drug benefit unless they are administered within a hospital. This is a big reason as to why we view prescription drug coverage as one of the core pieces of employer-sponsored benefit programs here in Canada. There are a few requirements for employers to be able to implement a benefits program, including the minimum of three full-time employees for guaranteed issue coverage. Employers can set up a plan with 1 to 2 employees. However, most carriers here in Canada would require medical underwriting subject to the carrier's approval in order to be able to issue that policy. Employers must also have an active business registration with the Canada Revenue Agency, also referred to as the CRA for short, as well as having a registered address in Canada and Canadian payroll with employees being paid in Canadian dollars. One way that a lot of employers get around the business registration as well as the address registration is through an employer of record or professional employer organization, often referred to as an EOR or a PEO. There are several different EORs and PEOs out here in Canada that are able to also offer employee benefits as part of their record keeping services. However, we find that EORs and PEOs can be very limiting in terms of the type of coverage and plan design that employers are able to offer to their Canadian employees, as usually those plans are going to be set in stone with little to no room for adjusting that coverage. Though not mandatory to offer your employees a benefits program, it is considered table stakes here in Canada. And once you have that program in place, it's super important to stay on top of legal and regulatory updates as it relates to the benefits plan. And having the right consulting firm can make it a little bit easier for employers to stay on top of different legal and regulatory updates relating to their benefit programs. A couple recent updates to keep top of mind in relation to benefits here in Canada include Quebec's Law 14, also referred to as Bill 96, which is the French language requirement for any businesses or organizations operating in the province of Quebec. There have also been several recent changes to Canada's federally regulated employment insurance, or EI benefit, including an increase to the maximum period that someone can be off on EI sickness benefits, which recently increased from 15 to 26 weeks. This is important for employers with an insured short-term disability and insured long-term disability plan, as they will want to ensure that their maximum periods, as well as their waiting periods for short-term and long-term disability, align with these new EI changes. Employers with a short-term disability program will also want to see if they are eligible for the Employment Insurance Premium Reduction Program, which provides lower rates for employers that have an STD benefit in place, which is equal to or greater than the benefit that's provided by our government-sponsored employment insurance. There were also some recent changes to the waiting period for employment insurance. Standardly, there is a 1 week waiting period before you would be eligible to receive EI sickness benefits. However, recent updates to EI regulations have waived this requirement for any employment insurance claims that occur between March 2025 and October 2025. Another important piece of legislation that impacts benefits is the Employment Standards Act, or the ESA, which recently made changes that prevent employers from being able to ask for a sick note for an illness of less than 3 days. And they also made recent changes for employees who have been employed for at least 13 consecutive weeks are now entitled to a new long-term illness leave benefit, which is going to be coming into effect as of June 19th, 2025. These new provisions provide up to 27 weeks of job protected leave due to a serious medical condition as defined by the employee's attending physician. And what this means for employers is that they need to keep employees that are on a long-term leave on their benefit program and must also keep a job available to them for up to the maximum period of 26 weeks. There are also some important changes which impact retirement, and Lindsay is going to speak to those briefly before we jump back into the benefits.
Yeah, thanks, AJ. So there aren't quite as many updates in the retirement space as there are in group benefits, in terms of what AJ has just gone through. But there is one fairly significant change that has to do with our capital accumulation plan, or our CAP guidelines. And before I get into the changes, I do want to highlight, for those that may not know, CAP guidelines, they really provide a framework for best practices when managing group retirement savings plans. They're not the law, they're not legally binding in any way, but they're essentially a list of best practices that, if followed, will stand up in a court of law. The guidelines themselves were introduced back in 2004, so a little over 20 years ago. And the goal, or the reason why they were put in place in the first place, was just to really provide some form of consistency and structure to group retirement programs overall. So for 20 years, they stayed static. There were no guidelines that were added. Nothing was really changed until this past September 2024, when the regulators introduced some revisions to these guidelines, and they're giving plan sponsors until January 2026 to implement these changes. I'll be referencing these guidelines and some of the corresponding revisions throughout the presentation, but I would say at this point, the biggest takeaway is that these CAP guidelines, they really just aim to support better retirement outcomes for plan members. And they do this by encouraging things like informed decision making and really overall oversight of the plan.
Before we go over some benchmark benefits here in Canada, it's important to understand how our government-sponsored healthcare services are organized, as there's usually little to no crossover between employer-sponsored and government-sponsored health insurance. Our government health insurance can be covered in two different categories, hospital and medical. This slide here shows what Canadians have access to for both of these services. Some of the major hospital services covered include hospital accommodations, nursing services, drugs administered in the hospital, as well as any of the equipment/supplies that are used in said hospital. And then some of the major medical services included are surgeon and your general physician services, such as your family physician, in addition to providing coverage for vaccines for minors, anesthesia, and diagnostic services. As I mentioned earlier, there's very little to no crossover between the government-sponsored and employer-sponsored benefits, and this is where we'll start to see the introduction of life insurance, dental benefits, as well as ancillary benefits such as employee assistance programs and spending accounts. To start by going over some benchmark benefits, we'll talk about life insurance. We usually see life insurance equal to 1 to 2 times annual earnings. However, this will vary by industry. Life insurance will also usually have a non-evidence maximum, often referred to as a guaranteed issue amount in the US, dependent on the employer size here in Canada. Short-term and long-term disability look very similar to disability coverage that we would see in the States, standardly providing 67% of weekly earnings for STD and 67% of monthly earnings for LTD, with both taxable and non-taxable options for long-term and short-term disability. One thing to make note of about the difference between Canadian disability benefits and premiums is that the life and LTD premiums tend to be much higher here in Canada, as we're spreading the risk amongst a much smaller population in comparison to that of the US, whereas our health and dental premiums are typically much lower than what we see on the US side, as our healthcare services as a whole tend to be less costly. We have both traditional and flexible benefit plans in Canada, although flex plans are more common for larger organizations with hundreds or thousands of employees, whereas most smaller organizations will have a traditional benefits plan with one set plan design. Whether a flexible or traditional plan, they usually will both include coverage for health and dental. And similar to the life and disability insurance, health and dental benefits will vary based off of industry, but overall, we typically see extended healthcare being reimbursed at 80 to 90% copay with an unlimited drug maximum, coverage for paramedical practitioners, including massage therapy, mental health practitioners, and your physical practitioners, in addition to coverage for vision, such as eye exams and physical glasses and/or contact lenses. Dental benefits are also usually reimbursed at 80 to 90% copay for basic services, 50% reimbursement for major and orthodontic services, with combined maximums for your basic and major services, whereas orthodontic coverage is typically based off of a lifetime maximum, and sometimes that maximum or that coverage itself will be only offered to dependent children of employees. Non-standard or ancillary benefits that are common include virtual care, employee assistance programs, global programs such as InPat, Expat Medical, as well as healthcare and personal spending accounts. When thinking of employer challenges in relation to a benefits program, attraction, intention, and retention is always going to be top of mind for employers, and this isn't going to be specific to just Canada. I'm sure that you've experienced this with your clients, and we have as well. Attraction and retention continues to be one of the top challenges for employers here in Canada, as our job market is incredibly competitive. We're also seeing challenges with hybrid versus remote work. In relation to benefits specifically, communicating benefit programs across different platforms has become much more complex with the hybrid versus remote work environment. Depending on the demographics of the organization and with multi-generational workforces, employees are going to have different preferences for how they communicate and how they absorb information. And because of this, employers have to have a strong benefits program and a strong communication and education strategy that accommodates for different methods of communicating and educating their employees. Disability leave and accommodations are also a challenge here in Canada. Although there's a lot of legislation and compliance surrounding these leaves, they can be very hard to manage and complicated to understand specific pieces of that legislation, almost as complicated as the FMLA in California. And a quick brain break for everyone here, something that's not as complicated as FMLA is Canada's love for hockey. We wanted to just break up the benefits discussion with a quick fun fact about Canada. Although ice hockey did not originate here, we are home to the NHL, which originated in Montreal, Quebec back in 1917. And Canada is the home country to some famous hockey players, which I'm sure many people are familiar with. Wayne Gretzky, Cindy Crosby, and Connor McDavid. And with the Stanley Cups starting shortly, we just want to say go Oilers. Now back to the benefits and some trends on drug spend. You'll see here the pie chart in the top left illustrates how the majority of drug costs for our plan sponsors are for specialty drugs, even though they make up less than 1% of total claimants. Very similar to the US, where specialty drugs make up the majority of that drug spend, but in reality are a very small fraction of the total number of claimants. Diabetes, heart disease, cancers, and mental health drugs continue to be in the top 10 diagnoses and make up a large portion of total drug spend. Along the right-hand side are going to be the top 10 drugs in Canada by spend, some of which, like Ozempic, Humira, and Remicade, will be very similar to top spending in the US. And because the majority of these drugs are brand name drugs that haven't came off of patent, they're going to continue to have a high cost associated with them, at least until we start to see generics come to market. With all that being said, though, all the carriers here in Canada have prior authorization processes for specific drugs, along with step therapy and drug management programs to help your clients mitigate their drug costs. The Conference Board of Canada released this survey sharing the top short-term priorities for employers as it relates to their benefit strategies. And unsurprisingly, the majority of employers consider containing benefit cost as their number one priority. Trying to ensure benefit costs are affordable, sustainable, and that plans are designed to mitigate costs and risks is always going to be top of mind for employers. Attraction and retention is also top of mind. As mentioned earlier, it ranks 5 on the list, with employers continuing to want to be able to offer benefits that are competitive in their industry, but also serve them as an attraction tool for recruiting. With the increased competition for talent, benefits and total reward programs continue to be top of mind for prospective employees. Enhancing employee health is also an important consideration for employers to ensure that they're able to maintain the health and happiness of their employees, as well as their employees' families, with the ultimate goal of keeping employees actively at work and healthy, all while mitigating increased costs as it relates to their benefit programs. Continuing on with some trends and statistics, the majority of employers here in Canada have a group benefits program, with almost 70%, 68% of workers being offered benefits through their employer. And again, though it's not mandatory or a legislative requirement, they really are considered table stakes. Of that 68%, about a third of employers offer a flexible benefits program, and the other 2/3 are traditional plans with one set plan design. The average cost of providing benefits is equal to approximately 6% of your gross annual payroll, or 5,330 Canadian dollars per full-time employee per year. Of that annual cost, a small portion of employers will have cost sharing on health and dental. However, it's not as common to have cost sharing on health and dental as it is for your long-term and short-term disability, as you can see in the chart on the bottom left-hand screen here. It's more beneficial to have employees pay for their short-term disability or long-term disability premiums, as it makes any benefits received on claim a non-taxable benefit. But that being said, if cost sharing is implemented on short-term disability and long-term disability, employees must cover 100% of those premiums for it to be taxable. Even if the employer covers a portion of those premiums, the entire benefit becomes taxable to that employee. A couple of things that differ on Canadian benefits and retirement before Lindsay goes over the retirement landscape in Canada. The first is that we typically have no open enrollment unless it's a flexible benefits program. For traditional plans, the only time an employee can make changes is when they have a qualifying life event, and that change has to be made within 30 days of the qualifying life event occurring. There are no requirements to offer a benefits plan. However, if there is one in place, they're usually set up as mandatory participation. Because they are set up as mandatory participation, that's another reason why cost sharing isn't nearly as common. And if it is set up, if there is cost sharing in place, we typically see it as a flat percentage of benefits that doesn't differentiate between single or family employees. Employers are also required to fund at least 50% of the total premiums. And though benefits are considered supplemental, Canadian employees really have the underlying expectation that their employer is going to have a benefits program in place. And they do consider it a fundamental piece of their overall total rewards package. I've spoken a lot about the big differences on Canadian benefits, and now I'm happy to pass this over to Lindsay. So she's going to speak about some of the differences on Canadian retirement.
Thank you, AJ. Okay, so the fiduciary responsibility element on the retirement side of things, it really does come back to those CAP guidelines that I spoke briefly about earlier on. And those CAP guidelines, they do function similarly to standards in other countries by outlining things, responsibilities like investment selection, fee disclosures, ongoing communication with plan members. But I think it's fair to say that overall plan governance is really not quite as rigid or regimented in Canada compared to a lot of other countries. We don't have anything like the ERISA Act or safe harbor legislation like there is in the US, as an example. So a lot of people outside of Canada are usually pretty pleasantly surprised to hear this when they're thinking about establishing a retirement program for their Canadian staff. Another big difference is around contribution limits. And this point is really going to depend on the specific products within your program. But if we look at the Registered Retirement Savings Plan, an RRSP as an example, which is the product in Canada that most closely resembles the US 401k, Canadians never lose unused contribution room. Whatever they don't use is carried forward indefinitely, which is a huge benefit for Canadians. Just move my screen here. Okay. So now that we've gone through CAP guidelines, a little bit about Canadian governance, I think a good place to start the retirement portion of the presentation is by explaining the Canadian retirement landscape and what most Canadians can expect in terms of retirement income in Canada. If you think of a pie chart that's split into three sections, we've got government pensions, employer-sponsored plans, and personal savings. And these three elements really make up a Canadian's retirement income when they reach retirement. So if I start with government pension, there's multiple forms of government pension that Canadians could be entitled to when they get to that phase of life. But the two that you see bullet points here on the screen, CPP and OAS, these are definitely the two most common forms of government pension that majority of Canadians can expect to receive really regardless of income level. So the first one there, Canada Pension Plan, CPP, this is something that every Canadian that has an employer in Canada pays into regularly. So on every pay, they're making a contribution into CPP and their employer is as well. This is a requirement. If you are an organization in Canada, you are required to make these contributions on behalf of your employee, and the employee themselves are as well. the amount that you get from the CPP benefit in retirement really does depend on how much you and your employer or employers, if you had several over the course of your career, pay into over time. So the numbers that you see there listed in 2025 are the monthly maximum payout amounts that Canadians are getting in 2025 and the monthly average amounts. Old age security works a little bit differently. It's not a benefit that you or your employer in Canada pay into regularly. It's simply provided to you from the government when you get to retirement, as long as you are at least 18 years or older and you've been a Canadian citizen for 10 years or more. So you can see there the maximum and average monthly amounts in 2025 are a little bit closer than the maximum and averages for the CPP there, but totaling in and around average $1,500 a month for both. Then we've got our employer-sponsored plan. So that's any sort of group retirement program, whether it's a pension plan from a former employer or a group RSP from a current employer, and then your personal savings. So if you have personal RSPs, other forms of savings programs, your home equity, other investments. But I think the biggest thing I want everybody to take away from this slide is that an employer-sponsored retirement program is very important in the big scheme of things in retirement, right? Like you look at the government pensions there, and I think a very common misconception or a myth that a lot of Canadians have is that they can kind of sustain their normal lifestyle in retirement off of CPP and OAS. But when you look at the numbers, the average amounts there, like I said, are about $1,500 a month or $18,000 a year, which really isn't going to be enough to kind of sustain your lifestyle. So very important to participate and have an employer-sponsored retirement program. Sorry, there seems to be a little bit of a delay when I try to move slides. Okay. So whether we are helping an organization implement a brand new plan or if we're reviewing the plan design of an existing plan, these things that you see on the screen here are some of the things that we consider when we're looking at the plan design of a group retirement program. Sector-specific benchmarking is very important here. A lot of organizations want to make sure that what they're offering or what they're planning to offer is in line with their competitors. From there, we would narrow down all of the plan design elements listed there, depending on things like benchmark, the organization's budget, if they have an existing plan for their US employees, as an example, that they might want to mirror, but also the company's overall philosophy. It's so important that the retirement program reflects the company's values and philosophy. I'm going to dive into this in a little bit more detail later on in the presentation because, again, it brings us back to those CAP guidelines and their revisions. Typically, the only cost to the employer to implement and manage a retirement program in Canada is going to be the matching contributions made into the employee's accounts. And if I take a bit of a step back to explain why this is, there is an investment management fee associated with each fund on the plan's investment platform. And these fees cover the carrier or the record keeper's administration costs, their fund manager costs, and then any applicable broker or consulting fees as well. The fees are actually paid directly by the plan members depending on how they choose to invest their money. So depending on which investment they choose for the money in their program. And then the fees are essentially built into the rate of return. So instead of deducting the fee separately from the account, it's already factored into the performance of the fund. And then this brings me to the final bullet, which is how are these fees determined? It's a very good question. So simply put, they are based on the size of the plan and not necessarily headcount, but cash flow and assets in the plan. So really, the higher the cash flow and the assets, the lower the fees and the more automation the carriers will offer. A part of our role is to make sure that these fees stay in line with the size of the plan. So we advocate on the client's behalf. We negotiate as low fees as possible, especially if we notice some significant plan growth year over year. Really, as the plan grows, everyone benefits. Sponsors have more automation available to them and members pay lower fees. So you've heard me mention the RRSP, the Registered Retirement Savings Plan, a little bit already. it's most similar to the 401k for those of you who might be familiar with a 401k, but there's definitely some notable differences as well. The RSP really is by far the most common product offering in Canada, regardless of sector. Employee contributions to the RSP reduce the employee's taxable income. The idea is that you contribute to your RSP when you're working, when you're in a higher income tax bracket, and you draw the money in retirement when you're in a lower income tax bracket. You know, you're no longer really making money through work anymore. And for employees, this certainly provides tax advantages, but the product itself is also very flexible. The money in the RSP is not locked in until retirement, and Canadians can actually access it prior to retirement if they need to without any loans or penalties. There would be tax. They would have to pay tax on the money at the time of the withdrawal because they didn't pay it at the time of contribution, but nothing in the form of loans or penalties. And then from the plan sponsor's standpoint, the RRSP is very straightforward to administer, and there aren't any sort of regulatory filings or costs associated with it. The next one you see there, the defined contribution pension plan, or the DCPP, it's still common in Canada. We're certainly still seeing it, but we're also seeing people starting to kind of move away from the DCPP. Assets in a DCPP are actually locked in until retirement. So there isn't much in terms of flexibility for employees if they need the money prior to retirement. There are also a lot of regulatory filings, which can be a bit of an administrative burden, and fees. There's annual assessment fees, per member fees for plan sponsors. So lots of reasons why we're seeing kind of a trend away from that product. A deferred profit sharing plan, or a DPSP, this is a product that is meant only for employer contributions. So it's really not common to have a DPSP as a standalone product, but we do see some organizations opt for an RRSP and DPSP combo plan, where the employee contribution is directed to the RSP and the employer match is directed to the DPSP. DPSPs allow an employer to add vesting rules of up to 2 years in length. So some companies look at this as a nice retention tool or even a budget tool, because if an employee leaves the company before they're considered vested according to those specific rules, they have to forfeit their contributions back to the company. But you know, it sounds like an awesome product, and it is, but I will caveat this by saying there are additional reporting requirements for the plan sponsor when DPSP money is forfeited. So just something to kind of keep in mind when they're thinking about which products to have on their shelf. A tax-free savings account, or a TFSA, this is, again, not necessarily a great standalone product, but it's a nice kind of side product to have. It's after tax dollars, so the tax benefits you get out of some of the other products, you're not necessarily getting with the TFSA. The TFSA is like the Roth in the US. But when it really does make sense is if the organization has a lot of newcomers to Canada. So this goes back to those contribution limits, which I'm going to get into in more detail shortly. But every Canadian has their own individual RSP contribution limit, and Canada Revenue Agency calculates this for us. So it's nothing that we have to do on our own, but they do take into account a percentage of your previous year's earnings. So if you are brand new to Canada and you have not worked in Canada before, you're not going to have any contribution room available to you, in which case a TFSA might make sense. Okay. So this is a sample plan summary that would be considered in line with most industry sectors in Canada. You know, we've got the product type is the RRSP, eligibility just meaning when are employees able to join the plan. So in this case, after 3 months of continuous service, you know, we do typically see organizations mirroring eligibility waiting periods with either group benefits waiting periods or other probationary periods. So anywhere I'd say between immediate to within the first 90 days is very much standard across all sectors. In this case, the employee can contribute any amount up to their own individual CRA limit, and the employer is going to match the employee's contributions dollar for dollar to a maximum of 5% of earnings. So again, we can get into those sector-specific details in terms of what the most common contribution match is, but the range, I would say, in Canada, regardless of sector, if somebody just wants a really high level range, would be between 3 to 6% of earnings is kind of where we're seeing that sweet spot for the match. In terms of withdrawal restrictions, so I mentioned that with the RRSP, the money is not locked into until retirement. It is accessible, but the plan sponsor can put in place in-service withdrawal restrictions, meaning while the employees are employed by that company, they can only access their voluntary contributions. So what that means is employee required simply means the amount that they are contributing that will be matched. It's not that they have to contribute and have to participate, but if they're going to and they want to maximize the match, that's kind of considered the required. So most commonly we see employers restricting voluntary contributions, so employees contributions over and above what is matched. In this case, because the match is 5%, let's say an employee contributes 8% of their total earnings, that 3%, so the amount above what is matched, is going to be allowed to be withdrawn while employed. The rest of the money should stay in the plan, just so that employees aren't really treating it like a bank account, right? Every time the match is going in, they're taking money out. We want to kind of save them from themselves by adding a restriction of some sort in place. And this is very much customizable. Organizations can decide if they want to restrict all withdrawals or open all of them to withdrawal. The default fund, this just means, there's an investment lineup on the platform, but if an employee isn't actively selecting where they want their money invested, the most common default fund we see is the target date fund at age 65. So the carrier, if they don't receive investment instructions from employees, they will default them into a fund. And the target date fund is by far the most common product type. It's an amazing investment option. So this is why I could talk forever about target date funds, but I won't bore you all. So just to know that this is definitely in line with benchmark across all sectors as well. In terms of fund lineup and fees, another aspect of those CAP guidelines is around the size and complexity of the investment lineup itself. It's recommended to keep the lineup between 12 to 15 investment options so that we're not overwhelming plan members with too much choice. As for the fees associated with these funds, like I mentioned earlier, this does depend on assets and cash flow, and really the larger the plan, the lower the fees. Fees on group plans in Canada are commonly much lower than fees on personal savings accounts, like a personal RSP at my bank, as an example. And this is really just due to economies of scale, right? Like we can go to these carriers and we can say we've got a group of this many people and we get lower fees than if I was one person contributing to my personal RSP. That said, when I do chat with plan sponsors or even brokers and consultants outside of Canada, specifically in the US, the reaction I tend to get is that the fees are high compared to what they see in the US. And this is simply due to the fact that the US is 10 times the size of Canada in terms of people and assets. There's actually a saying that goes something along the lines of Canada is a little country in a large overcoat. And this is just referring to Canada's vast geography compared to its relatively small population. So back to the economy of scale, it makes sense that the fees will also be higher in Canada. But important to note that within Canada, group retirement fees are usually much lower than retail bank fees. So this brings us to the advantages of group plans. I'll reference RRSPs again here since they're the most common product type and they're available to any Canadian, whether inside or outside of an employer-sponsored arrangement. One key aspect is that individuals can hold multiple RSPs and contribute to them at the same time. However, contribution limits are still going to apply, something I've kind of been touching on throughout the presentation. And like I keep saying, I am going to get into the specifics shortly, but the important point is that while there's no restriction on the number of RSPs someone can have, the total contributions must stay within their annual limit. So all that to say, let's look at some of the additional advantages of group plans compared to individual plans. So first off, it's easier to save, right? When it comes directly off of your paycheck, I know for me, if I don't see it, I don't miss it. I just kind of get used to that new net pay that goes into my bank account with each pay. Probably the biggest benefit is the employer contribution, right? Almost all group retirement programs have a match or an employer contribution of some sort, which the employees are absolutely going to see as the number one benefit. It's like free money. They're also getting an immediate tax reduction with the group RSPs. So, if I have an RSP at a personal RSP at my bank and I'm making lump sum contributions from my bank to my RSP, every month, as an example, when I go to file my taxes, I'm going to get the tax benefit at that point in time. The really nice thing with the group RSP is that you're getting that tax deduction, that tax advantage on each pay. So if I'm contributing $100 per pay to my RSP, my net take-home pay is not going to be $100 less. It'll be more like $65 or $70 less, depending on my own personal income tax bracket. We are also seeing tax deferred growth, and this is regardless of whether it's a personal RSP, a group RSP, but what this means is any growth within the product. So your rate of return, you're not paying tax on, it's growing tax free, which is a huge benefit. We have access to our insurance carriers, leading fund managers, and those lower investment management fees like I've been talking about because of economies of scale. It's a really nice way to consolidate your savings. Either way, RSPs are very portable, bringing money in or out when and if you leave the company, which makes it super flexible, super nice. And then the online support that we have through all of our insurance carrier partners is really excellent. Okay, so I keep talking about contribution room, and this is where I'm going to kind of dive into a little bit more detail on it. Canadians do not, like I mentioned, they do not have to calculate their RSP room on their behalf. Employers do not have to monitor this for Canadians. This is kind of their responsibility because, like I've been saying, people can have multiple RSPs outside of a group-sponsored RSP that the consulting firm, the insurance carrier, the organization itself, they're not privy to. But this is how it's calculated. So Canada Revenue Agency takes the lesser of two numbers, either 18% of your previous year's earnings or a specific dollar amount that they set and that changes every year. In 2025, that amount is $32,490. This is where they get that nice advantage of unlimited carry forward room. So essentially, as soon as you start working in Canada at whatever age, 15, 16, your part-time job, you start accumulating contribution room. Whatever you don't use, you never lose. It's carried forward indefinitely. And then they subtract your prior year's pension adjustment if that's applicable. Not everybody has a pension adjustment. I'm not going to get into that in too much detail, just in the interest of time. If there are any questions about pension adjustments, please do let me know. But this is sent on every Canadian's notice of assessment form that they get when they file their taxes every year, and it's laid out very clearly, what their current year's contribution room is and what previous year's carry forward room is as well. Okay, time for another brain break, a little fun fact. So I do have to say that I am all for the Oilers winning too. So let's hope my 7-year-old is a huge Oilers fan. But after hearing about AJ's fun fact, if you're like me, you might actually be surprised to learn that while hockey is usually considered Canada's national sport, it's actually lacrosse that holds the official title. And something kind of cool that I read is that it wasn't only a game when lacrosse came about. I think it was in the 1100s. It wasn't just a game for fun. It wasn't just for exercise. Back in the day, it was actually used to settle disputes. So I was like, oh, can you imagine you're arguing with your partner about whose turn it is to do the dishes, and it's like, oh, let's take this outside and settle it over a game of lacrosse. Okay, so it is very important to consider your workforce demographic when designing your plan. It isn't, and I don't think it should be, one size fits all. And with that, we don't want to make broad assumptions or label generations, even though it can be really easy to do that. Sometimes I know I've been bad for that in the past too, but we want to aim for savings flexibility instead of assuming anything based on age. You're a Gen Z, you're reckless with your money. That is a stereotype, but we can't paint everyone with the same brush because that's not going to be true of all Gen Zs. And then effective communication in group retirement plans really does start with understanding employees' diverse financial knowledge, differing priorities, tailoring messages to their level of familiarity and using jargon-free language that's simple, maybe offering some personalized guidance. It's really going to help plan members make informed decisions. We also want to design for life phases. So keep in mind that a young employee fresh out of school who may have a whole whack of student debt would much prefer a student debt repayment program, because at least until that debt is paid off, retirement savings is probably going to be the furthest thing from their mind. And having this offering, like a student debt repayment program, in addition to a product like an RRSP that's meant for retirement savings, but can also help with buying or building a first home through the first time homebuyer plan government program. It just provides those options and flexibility. And finally, and something that I mentioned earlier, is that we want to make sure that the plan purpose is clearly defined, which is one of those CAP guideline revisions, but that it's a reflection of the company's missions and values as well. And I'm going to give an example here. We were recently asked to review a company's group retirement plan design against benchmark and to see if we had any recommendations of things to change. They were not a client at the time, and they were really just looking to have kind of like a second set of eyes on their plan design. Their product was the defined contribution pension plan, the DCPP. You'll remember that that's the one that has no flexibility. The money remains locked in until retirement. And what I haven't said before, and that I think is important to say here, is that for some organizations, this still might be the right product if it reflects their company's philosophy. For this specific company, while putting together our review, perusing the company's blog, there were a ton of blog posts highlighting individual differences as it relates to financial wellness, different phases of life. So really the product offering on their program did not align with their philosophy, and it made it very easy to recommend changing the product and adding options to kind of cater to differing needs and savings goals. The change, it would give employees different options depending on what they need at that point in time, but it also gives the organization peace of mind knowing that their retirement program does reflect the values and company philosophy. Okay, we are getting there, everybody. Thank you so much for your patience. I want to make sure we have some time for Q&A as well. Some trends we've been seeing in the industry are a result of those CAP revisions, but I wouldn't say all of the trends are because of that. So there's a really big focus on education right now, and I don't necessarily see this as a trend, but something that I think will and I think should stick around for the long term. One of those CAP revisions states that there should be a focus on education not only at enrollment, but throughout the life of the plan. And this is helpful because not only does it encourage participation in the plan for those that may not have enrolled when they were initially hired or initially eligible, it also reminds employees of the benefit being provided, which can be really helpful from a retention standpoint, right? It's also very common right now to add a Sharia compliant fund to investment platforms. This is very helpful and kind of like a big check from a DEI perspective. A Sharia fund follows Islamic principles. So all investments have to comply with Sharia law. So this means avoiding industries like gambling, alcohol, interest-based financial services, and focusing instead on socially and ethically responsible investments. The Muslim population in Canada has actually grown from 2% in 2011 to almost 5% in 2021. I'm not sure where it's at in 2025, but you can see that big jump in a 10-year time span. It does make sense why we're seeing so many organizations adding this to their lineup. We're also seeing a trend towards shortening eligibility waiting periods. So that sample plan design that we talked about a few minutes ago, anywhere between immediately eligible to within the first 3 months of hire is definitely something that we're seeing more of versus 1-year waiting periods to join programs, which was the case, years ago. And then finally, we're also seeing many companies add ancillary benefits as a side product. So, tax-free savings accounts, first home savings accounts, student debt repayment, first-time home buyers, in addition to more longer-term retirement products. And again, that just comes back to the flexibility and choice to offer your plan members. So we've discussed these CAP guidelines in quite a bit of detail to this point. So the last question that you might have is, how are plan sponsors supported to make sure that they're doing their due diligence and following these CAP guidelines and these CAP revisions? And that's really where we come in. So as a broker in your own market, part of your role is to assist your employers in making sure that risks are being mitigated around their plan. And in Canada, we do this as well. We meet with our clients on a very frequent, regular basis to address questions around benchmark. How does their program stack up against their competitors? You know, we're always looking to make sure they're paying the lowest fees possible. We look for trends and anomalies in member behavior within the plan, and then use that information to come up with an appropriate education and communication strategy throughout the year. And really, all of these initiatives that I just kind of spit out in a really short amount of time are a big check mark to those CAP guidelines. Finally, we build personal relationships with our members through Make Sense. So this is a Cowen service that we offer all of our clients for the life of the plan to help not just with understanding of the program, but with investment guidance to make sure that employees are choosing investments that match their risk tolerance level and time horizon as to when they need to access the money. It's something that we've been doing for years, and I think it's a great value add for plan members, but with the recent revisions around the CAP guidelines, and you know, that overall emphasis on continuous education, it's even more important now. Okay, so I know we've covered a lot here. We've only got about 4 minutes left or so. I hope the material's been insightful, but let's take some time for Q&A. AJ and I would love to hear your thoughts and answer any questions you might have.
Thank you very much, Lindsay and AJ. We do have a question that I was going to pose to you from one of the viewers that says, do employers work with the same broker partner for benefits and pension? If so, is this preferred and why?
That is a very good question. There's no requirement to work with the same broker for benefits and pension, but I do think that it is a really good idea. It helps kind of make that total compensation offering very cohesive, right? I know at Cowen, myself and Jackie, myself and AJ, the benefits and pension side of things, we really do partner on member communications. We do a benefits at a glance document. It just kind of helps keep it in one spot for plan members. You know, sometimes it's also nice to have the same record keeper or carrier for both benefits and retirement side of things, because brand recognition, single sign-on, that type of thing, that's not required either. But yeah, I think it's important to first kind of make sure that the plan is doing what you want it to do. But yes, from an overall cohesive communication standpoint, we would recommend it working with the same broker for that.
Perfect. Perfect. Another question, I think this is more for AJ. The question was, are we seeing, you talked about ancillary benefits. Are we seeing a difference or a shift because of the different generations in the workforce?
I would say that's probably one of the primary reasons pushing ancillary benefits is that we have such diverse workforces. Like we have, younger generations who are earlier on in life that might not have many underlying health conditions. They're not taking diabetes or maintenance medications for high cholesterol. And so for them, they'd probably prefer a healthcare spending account than an enhanced or drug plan. Whereas you have people or older on in their life stage that have very different healthcare needs, which isn't going to necessarily, they might not want a health spending account or a personal spending account. So I would say that the multi-generational workforce is probably one of the biggest reasons we're seeing a push for ancillary benefits, just to accommodate for the varying needs of people at different life stages.
And then we have another question. Thank you, AJ. For another question here, I think this is more benefits related as well, AJ, is that are we seeing employers offering perk programs?
Yes, I would say probably over the past year or two, I've had more requests for like discount programs, whether it's discounts, just generalized discounts here in Canada or specific to like a gym membership discount, more so over the past 2 years than I have ever before. So short answer, yeah, we are seeing lots of requests for perks and discount programs for employees here in Canada.
Perfect. Perfect. Makes those savings those savings go further and back maybe to the retirement plan.
It does. And there are programs as well. Like there are perk programs that are no cost to the employer to offer. They make money by employees using that discount code. And so it's a win-win all around for employees and employers to have one of those free perk programs in place.
Perfect. Perfect. Well, that's all I'm seeing today in the chat. Thank you very much.
Well, if we don't have any other questions, I will close off our webinar and just thank everybody for attending. I know we've all got busy schedules. A copy of this webinar recording as well as a PDF will be sent out following the discussion. And I also just wanted to say that we really value our partnerships around the world and being able to work with different experts to kind of see that big picture benefits cross borders is a great experience that I get, and I know Lindsay feels that as well. And we just hope that you've gained enough insight in the Canadian benefits landscape to start that conversation with your clients. And the entire Cowen team is here to support and continue that conversation. So thank you, everybody.